Good afternoon, happy October, and welcome to AIADA's AutoTalk. I'm your host, Rachel Soleimani. Before we get started, a few housekeeping items. Anyone who has registered for today's program will be receiving a copy by the end of next week. And if you have any questions, you can send them to me and I will pass them along to Erin and she will respond to you directly. Today we welcome our dear friend, Erin Kerrigan. Erin is the founder and managing director of Kerrigan Advisors. Their singular focus is working with dealers, their families, and investors to maximize the value of their auto retail investments. Erin, with that, I'll leave it to you.
Thank you, Rachel. Thank you, AIADA, for inviting Kerrigan Advisors to present our most recent Blue Sky report. We are excited to share our view of the 2024 buy-sell market and the trends we are seeing as the year quickly wraps up. Before I get started, I am pleased to share Kerrigan Advisors celebrated its 10-year anniversary this year. We are very proud of the team we have built over the last decade. It is because of their dedication to top client service, professionalism, and excellence that our firm is the leading sell-side advisor in auto retail, having completed $9 billion worth of dealership sales on behalf of our sell-side clients, more than any firm in the industry. We're particularly proud of the work we've done with Toyota dealers, key AIADA members, selling more than 35 Toyota franchises since 2015 and leading the sell-side industry in this endeavor. Kerrigan Advisors is unique in that we do not employ a brokerage model. All of our team members work together to ensure we achieve our clients' personal and financial goals in each engagement. With that brief overview of the firm, let's jump into today's discussion. We have lots of information to share. Now, coming off of the Summer Olympics, we thought it only appropriate to employ this Olympic theme to our presentation today. The resilience that we saw in our U.S. athletes reminded us a great deal of the determination we continue to see in our industry as we overcome both expected and unexpected challenges. Now, just like the high U.S. medal count in Paris, the buy-sell market of 24 is on track for another exceptional year. Through the first half, 204 buy-sell transactions were completed, representing 381 franchises. Now, at this rate, transaction activity is nearly double pre-pandemic levels and annualizing at 760 plus franchises sold, a new industry milestone. The elevated rate of industry consolidation continues really unfazed by the economic impact of the CDK cyber attack, high interest rates, which are still high even with the recent cut, the market headwinds of low vehicle affordability, and the anemic level of EV sales. Even multi-dealership transactions, which of course are more sensitive to interest rates in the financial markets, these still remain at elevated levels with 112 closing in the trailing 12 months. Now, this data reflects the accelerating trend of consolidation that we are seeing in our industry. Since the pandemic, a growing number of dealership groups, both big and small, are selling to regional and national consolidators, such as Kerrigan Advisors' most recent large client, the Leith Automotive Group, which sold to Holman this year. And of course, last year, the Coons Automotive Group, the third largest transaction in industry history, sold to Asbury. Our firm believes that the high number of multi-dealership transactions highlights consolidators' confidence in the industry's long-term profit outlook and their bias towards scale, considered by many of these groups to be a foundational requirement for enhanced future profits and productivity. 2024's elevated buy-sell activity is largely driven by an increase in sellers coming to market. These folks are seeking to capture strong blue sky values, which do remain considerably above pre-pandemic levels for most franchises, not all. The Kerrigan Blue Sky Index, a barometer of industry franchise value, is 74% higher than 2019 levels. For the majority of franchises, dealership sellers recognize that current blue sky prices, while down from their peak, are still highly attractive on a historic basis. Now, some will ask, how is it possible that blue sky is so high when earnings are down a great deal more, 35% on average based on the public's data? Now, in Kerrigan Advisors' experience, buyers never really priced blue sky based on the peak earnings of 22. Rather, they always expected earnings to normalize as they currently are, and thus they base blue sky on a expected normal earnings, not on peak earnings. While profits, of course, tripled between 19 and 22, as a result, blue sky did not rise at that same pace and therefore is not coming down at the same pace. But there is no question we are seeing sellers today seeking to lock in today's elevated values and avoid the potential for further valuation degradation if earnings do continue to decline. Our analysis shows that the decline in industry earnings is primarily due to a reduction in new vehicle gross margins, though they do seem to be moderating, with the second quarter down just 3% from the first quarter. The publics continue to project 2024 gross margins will level off at about $3,000 per copy on the front end. Now, the publics include the back end money received by the OEMs. So these are elevated relative to most private dealers. On an inflation adjusted basis, by the way, if 3,000 is the new fully baked front end gross margin, that would represent a $500 improvement from 19's average new vehicle gross margin, or approximately a 50% increase from the pre-pandemic average. Now, interestingly, these expectations are consistent with OEM projections. According to Kerrigan Advisors' annual 2024 OEM survey, 62% of OEM executives expect new vehicle gross margins to remain above pre-pandemic levels, with 39% projecting margins will normalize about 50% higher than 19, exactly the public's projections. If grosses do normalize at these levels and new vehicle sales continue to rise, the outlook for industry profits is strong, especially if OEM incentive spending, which is the blue line on this graph, continues its march upward. It appears Wall Street agrees with this positive sentiment, particularly for the largest consolidators. The Kerrigan Index through July was up 56% from its 22 low and just 16% below its all-time high that it reached in September 21. For those who are not familiar with the index, it includes the 7 publicly traded auto retailers and is market cap weighted, much like the S&P. We feel it is a great indicator of Wall Street's view of an investment in our industry, which is currently pointing in the upward trajectory. With that overview of the market, let's look at the buy-sell market trends from both the buyers and the sellers' perspective, starting with the buyers, many of whom, particularly the large private consolidators, believe more is better. Consistent with the industry's consolidation trend, the largest private groups are very focused on scale as a key differentiator for future success. To that point, we saw the largest private groups' share of the buy-sell market increase nearly 20 percentage points in the first half of the year. Now, Kerrigan Advisors hears from more and more private groups seeking sizable acquisitions, both in their existing markets and new growth markets. Unlike the publics, these private dealers are untethered by their shareholders' demands for accretive acquisitions. They can take a long-term view on the prices they pay for blue sky, deciding to pay significant price premiums for strategic franchises that they do not expect will come around again in their lifetimes, and therefore they will add them at a price premium, outpricing the publics. Perhaps the best example of this is 2 Toyota dealerships that our firm was recently honored to represent in San Antonio and Houston, Texas. Both of these dealerships sold to top private buyer consolidators who were able to pay significantly more than their public competitors. Now, one thing we are seeing as it relates to buyer sentiment is greater confidence in the value of the US franchise system. With EV inventories aging by the day, OEMs increasingly recognize dealers' critical role in ensuring a productive distribution of new vehicles. Dealers are market makers, and they ensure that vehicle pricing efficiency exists, and really they're executing on an economically attractive sales system that minimizes OEM's inventory risk and carrying costs. NADA just produced a study supporting this idea. OEMs who were previously infatuated with Tesla are increasingly recognizing the significant flaws in Tesla's direct-to-consumer model and the enormous benefits of a franchise system, particularly when you have dealers you're leaning on to sell off all this excess EV inventory. The failure of the EV sales model to meet OEM expectations has really led to a pullback in OEM's proposed changes to the franchise model, as is evidenced in this slide in our OEM survey results. The majority of OEMs in 24 do not expect to introduce an agency model in the US, a notable increase from last year. The US franchise system is really regaining legitimacy in the eyes of the OEM, and buyers now feel more confident in their franchise expansion plans, supporting a continuation, in our view, of the consolidation trend we continue to see. This is particularly the case given that liquidity and access to capital does remain very high for the largest dealership groups. By way of example, the publics saw their capital availability increase by $370 million in the second quarter alone to a stunning $7.37 billion. And they're putting that capital to work, spending $1.2 billion on the acquisition of US dealerships in the first half of the year, up 20% from the same period last year. This activity is in part driven by their improving blue sky multiples, up an average of 62% in the last year, which demonstrates Wall Street's vote of confidence in the public scaled up business model. However, while these public companies have clearly indicated their strong desire to acquire US dealerships, they do have many options for their capital and will seek the highest return investment on behalf of their shareholders. In the first half of 24, the publics acquired a record 161 international franchises for about $1 billion, roughly the same amount that they paid for just 23 franchises in the US. The pricing of these international dealerships was at a significant discount to US multiples, making international acquisitions more accretive to the public's earnings. Even with the public's improved valuation metrics, many of these companies often find themselves priced out of acquisitions for the top US franchises they want. You can see here at the public's current blue sky multiple, most of the top franchises are out of reach. Now, this is the average blended public multiple. So some of the publics have higher multiples, and some of these franchises aren't out of reach for certain publics, but you can see that on average, they're priced below. As a reminder, for an acquisition to be accretive to a public company, the blue sky multiple of the acquisition must be below the public acquirer's blue sky multiple. Now, while these companies also price franchises on a pro forma basis to ensure an acquisition will be accretive in future years, generally speaking, shareholders prefer acquisitions that are accretive on day one of the ownership of the target's dealership. Okay, with that overview of how the consolidators are looking at the buy-sell market, let's turn to our clients, the sellers, many of whom believe the game is changing in auto retail, much like the Olympics changed quite a bit by including braking this year in the Olympic Games. Smaller private dealers increasingly believe they either need to grow their business or sell, as scale becomes an imperative for future success. Perhaps the best evidence of the need for size is the tremendous growth in groups with 11 or more dealerships since 2010, relative to the shrinking of those with 5 or fewer stores. Auto retail, we believe, is in the midst of a transformation in which technology and technology solutions, including AI, will become a critical component of retailing. For many of the largest groups, the utilization of technology is projected to dramatically increase their employee productivity and ultimately enhance profitability relative to their smaller competitors. And the largest groups, by the way, are doubling down on this proprietary technology, while private dealers are often struggling to achieve a return on their data investment. These dealers, these smaller private dealers, lack a sufficiently large enough organization and specialized staff and executives to develop and deploy proprietary solutions. As a result, many private dealers are stuck purchasing a broad array of expensive systems, often creating a labyrinth of data that is very difficult to integrate and manage, ultimately becoming a counterproductive situation where costs rise with little to no increase in sales and profits. Cox Automotive's 2024 Power of Data study highlights the technological difficulties faced by many auto retailers. The majority of the dealers surveyed, by the way, they've surveyed over 500, reported that challenges using their data to better operate their business, there were 70% reported these challenges using their own data. 66% reported concerns about privacy and compliance, and 54% reported data conflicts across multiple sources. All of these challenges are leading to 44% of dealers surveyed holding off completely on adopting new data solutions. We do at Kerrigan Advisors find more and more of our sell side clients are contacting us and deciding to sell because they no longer believe they can compete with their largest competitors who seem to be playing a different retail game based on data and technology rather than human insight, which is how most of our clients are still operating their business, really relying on the human aspect of retailing rather than the data aspect. In addition to this reason, some sellers are particularly concerned about the return of high inventory levels, with 70% of OEMs now projecting a 60 to 90 days supply in the next 12 months, leading to a dramatic rise in floor plan expense. Since 21, floor plan expense has increased by over $400,000 for the average dealership, according to NADA. $400,000 is a big swing in an expense line and is becoming a painful drag on many dealers' earnings. The floor plan exposure is most pronounced for certain franchises with unsustainably high days supply inventory. And I'm going to talk about that when we talk about multiples. This rise in floor plan is beginning to degrade some dealers' balance sheets. Today, the average dealer's current ratio, which reflects current assets relative to current liabilities, is 25% lower than it was in its peak in 21. Dealers' shrinking working capital is leading some to decide they are ready to exit rather than see their liabilities continue to rise. Sellers are also concerned about the EV transition and the government's and OEM's miscalculation on consumer demand. EV sales growth is plummeting, dropping 46% in 2023, 46% in 2023, and is now just 7% in the first half of 24, leading to ballooning inventories of new EVs as the OEMs continue to employ the field of dreams strategy of if we build it, they will come. Dealers in CARB states, these California regulated states in particular, are seeking to exit before they are faced with an even higher level of mandates on EV inventory and a cap on their ICE sales. The final reason we are seeing more sellers come to market is their rising skepticism regarding the OEM's ultimate long-term intentions for their family's business, particularly as more OEMs seek fewer larger dealer groups in their network. In our recent OEM survey, 19% of executives expect that OEMs will be the exclusive owner of the customer relationship and data in 5 years. That is a 16% rise from last year and a notable shift from the historic precedent in which dealers own the customer data and relationship. The fact of the matter is that the franchise of the future, while still very valuable, will not likely look like the franchise of the past. Kerrigan Advisors estimates that over 50% of the industry is in the midst of a dealer generational transition. The next generation, in many cases, is not either prepared or frankly willing to lead their business through today's data-driven transformation, resulting in many families deciding the time is right to sell. With that review of the buy-sell market, let's discuss franchise valuation, which, like the Olympics, has more winners and losers, particularly as inventory variability widens. Unlike the pandemic years when inventory was limited and every franchise saw a great deal of profits and buyer demand, today there is a wide chasm, 100+ day difference between those with too much inventory and those with the 30-day supply. Kerrigan Advisors finds that franchises with less than 60-day supply are in very high demand, while those with over 100 are finding it more challenging to identify buyers. And there is, of course, a high correlation with inventory day supply and dealers' level of trust in a franchise. In a time of uncertainty, dealers are further prioritizing OEMs and business models that are working and that they trust, where inventory levels are reasonable and dealer profits are more consistent. Now, another key trend that we are finding is the strength overall in the import brands relative to the domestics. As you can see here, through the first half of the year, import franchises grew vehicle sales at a healthy 6.5%, led by the non-luxury segment, which grew at a remarkable 8.6%. By comparison, domestics saw their sales and market share shrink. Now, consistent with these vehicle sales results, the buy-sell market saw an incredible decline in domestic buy-sell market share and a significant rise in import transactions. As you can see, domestic dealerships represent just 44% of transactions in the first half. That's down 10 percentage points from 2023. By contrast, import luxury and non-luxury franchises both saw an uptick in the buy-sell market share, with non-luxury segment claiming its highest percentage in the last decade, 40% through the first half. Now, to put this all into perspective, import non-luxury stores only represent about 21% of dealerships. So right now, their buy-sell market share is double their market share of franchises in the market. Now, another key factor in today's buy-sell market is, of course, the OEM's EV strategies. We know that most OEMs have overcommitted to a rapid shift to EV production, and this has created all sorts of ripple effects within the industry. It is worth noting that Toyota has been remarkably conservative in its internal estimate for EV production, planning just 18% EV production between 2025 and 2028 models. By stark contrast, Mercedes is all in on EVs with 54% planned production. Pretty different than the realities of the marketplace in 2024, where just 7% of the market is being garnered by EVs. Kerrigan Advisors is starting to see the impact of OEM's EV strategies on valuation and franchise multiples. And we do expect this to be a major factor going forward in buy-sell valuation. To that point, we did downgrade Mercedes multiple this quarter to negative. That negative outlook is a result of the fact that we continue to see Mercedes inventories rise and declining profits, particularly for EVs. And that is in contrast to the rising buyer demand we see at Porsche, Lexus, and BMW, who have managed the EV situation much better. Mercedes is also, by the way, one of the most aggressive luxury franchises in managing its network, currently seeking fewer larger dealers and willing to challenge buy sells in order to get the buyer they want in place. For similar reasons, we are also placing a negative outlook on Hyundai's Blue Sky multiple. Dealers share with us that Hyundai is seeking regionally dominant dealers and is also active in exerting its rights on buy sells and demanding new image facilities. Ultimately, this strategy often leads to fewer buyers interested in the brand, which brings down value. It's just an economics 101 situation. More buyers, and that results in higher demand, higher price, fewer buyers, lower demand, lower price. This quarter, we also downgraded CJDR and Nissan's multiples as both franchises struggle with inventory and dealership profitability. By contrast, we increased Mazda's multiple. The franchise continues to see the benefits of the TFS partnership, and sales per franchise are on the rise for Mazda, along with profits and buyer demand. Before I close out this webinar, I know one question I am often asked is, what should these multiples be applied to? With earnings normalizing in the last 12 months, we are pleased to say that the market is returning to the tried and true method of using current earnings to value Blue Sky. In many regards, this is a breath of fresh air, with the guesswork on normalization subsiding and clarity on future earnings improving. For most markets, a return to pandemic earnings is not expected for many years, and therefore buyers are ignoring those periods and instead focusing on a dealership's 2024 performance for valuation purposes. In closing, while the auto industry continues to throw us many curveballs, including a cyber attack to add to the list, the one thing successful dealers have in common is grit. Dan Gable, a gold medal Olympic winner for the United States in 1972 and considered one of the best wrestlers of all time, said, "Gold medals aren't really made of gold. They're made of sweat, determination, and a hard-to-find alloy called guts." Guts is something we find in each and every dealer with whom we interact, and a characteristic that will continue to pay immense dividends as our industry evolves. Thank you for your time today on this webinar, and please do not hesitate to reach out with any questions, as Rachel mentioned, about the webinar, about our Blue Sky reports. I'm always happy to have a confidential conversation about the buy-sell market, valuation, and of course, Kerrigan Advisors client services.
Erin, thanks so much for sharing this really important information. I always look forward to having you on and hearing what you and your studies have to say. Again, you will all be receiving a copy of this webinar by the end of next week. Join us for our next webinar on Tuesday, October 29th at 2 p.m. Eastern, as WarCloud discusses how dealers must focus on recalls and warranty work in the tectonic shift in your service operation. For more information about AIADA, visit aiada.org. Thanks for joining and have a great day, everyone.